Hey, it's Neil. And yesterday we had a rough day in the stock market, and at the moment we're about to open in about 20 minutes. Futures are looking bad. So yeah, I mean the topic du jour is, of course, the Fed's interest rates, quantitative easing versus tightening, and trade with China, um, and all that combining into kind of a shitstorm. So the thought occurred to me yesterday that I wonder how these volatile days correlate with the uh, with the overall stock market returns. So what I did was I went to Yahoo Finance and I downloaded the historical data from January 1970 up to yesterday or today, I guess. And I put that into a spreadsheet because I like spreadsheets. And I put it into a pivot chart because I like pivot charts. So what we're looking at here is the blue bars are the number of days during each year where there was at least a 2% move down. And you can see that if we look at recent history, 2018 had quite a number of them, about 15. It was 15. 2016, 2015, 2014, much lower. 2011 had a bunch, 21 days greater than 2% down. Let's see, 2010 we had 10 of those days. 2009, 28 down days like that. 2008 had 41 down days. Now, keep in mind, there's about 250 trading days in a year, so 41 is a huge number. And 2007 was 11. So, and then these red bars are the year over or the 12-month change. So if you bought at the open at the beginning of the year and you sold at the close at the very end of the year, what's the change? And obviously 2008 had a negative 38%. Some of these other negatives are sizable. 2002, 2001, 2000. Obviously, that was the dot-com crash. What's interesting about the dot-com crash actually is that it really accelerated from 2000 to 2002, and I just find that interesting because I hadn't really thought about it that way. And then if we look at up days as well, let's change this from count to sum. So now the greenish yellow bars are the yearly changes. The blue is still down days, and this red is up days, up more than 2%. So I'm going to take off the yearly change just so we can kind of see here. Okay, so here we've got greater up days than down days, greater up days, greater up days, greater up days, greater up days. And then these ones, here's 1987. 87 was obviously Black Monday, or Black Friday, Black Monday. I don't know, August or October something or other, 1987, biggest one-day crash at that point. And we actually had an equal number of up days and down days that are greater than 2%. So what we're looking at basically is a historical measure of volatility. The more 2% up days, 2% down days that you have, then the more gyrations you're seeing in the market. And just to get a more global view of that, if we look at just the number of 2% days, up or down, we'll see that there are definite waves here. So we have the 90s going into the dot-com crash, and then the crash starting. And then 2004, 2005, there were none. It was a very quiet market. And if you remember during that time, things were ticking up very nicely. Then we start to get some more volatility in the market and crash. 2012, 13, 14, 15, 16, 17, obviously those were that straight line going up on the S&P. And then 2018, we started to see some choppiness, some toppy kind of patterns. So, what does that portend? If we look at the 87, it was a lower volatility environment, and then it explodes and then comes back down. So if we look at that compared to the year-end change, or the yearly change, it's just interesting. So, higher volatility doesn't necessarily mean down markets. So like in '87, we ended up, slightly positive for the year, which is crazy considering, it was at that time probably the most volatile year in previous, several decades anyway. Uh, Early '70s, we had all kinds of stuff going on with oil shocks and inflation and whatnot. And yeah, so I mean, the question is always, okay, what do we do now? And we see that for the first time in a long time, on a historical basis, we're seeing volatility rising. So 2018 had 20 of those days, and the last time we had something like that was 2011, and that was in the whole financial crisis regime. Then the last time before that was the dot-com crisis, or the dot-com crash. And the last time before that was 1987. So you can see that it's not a conclusive thing. It's not saying that greater volatility means the market's going to crash, but it's an indication that we are in dangerous waters here. So anyway, I just thought that was interesting and wanted to share it.